So we're going to talk about how we trade leverage and margin. So very important to understand that when we're trading spread betting products, that they are very, very highly leveraged. And all the risk disclaimers that I ever read all basically revolve around these principles of margin and leverage, that if you don't understand exactly what you're doing, that your losses can certainly exceed your initial deposit. So you have to understand that margin is what we run margin based upon the amount of money we have deposited, but the leverage is what's quite crucial into how we use our margin, in that the more leverage we use, the more money we could potentially make, but also the more money we could potentially lose. So leverage is very, very important when understanding what we're trying to achieve in the financial markets. So the risk warning, again, which will highlight all the things I'm going to talk about in this presentation. Remember that spread betting and CFD trading carry a high risk or capital, resulting in losses that exceed your initial deposit. They may be suitable for everyone, so please ensure you fully understand the risks involved. Now, the information comments provided here in no circumstances or a consideration or offered consideration or software to invest. Nothing of interest to investment advice. The information provided is believed to be accurate. The data produced. Again, education only. The content of the webinar is posted by the moderator, not intro.com. The content does not constitute financial investment or tax advice. Intro.com does not set any liability for the content made during this session. So trading leverage. So we have to understand the real basics, and I mean the absolute basics of putting money into a trading account and what that means. You've heard the term, it takes money to make money. Okay? And money makes money. All these things have been around in history, since man began. It takes money to make money. Money makes money. But it all revolves down to how much money you've got. It can be more true in the world of spread betting and trading. The more money you have, the more risk you can take, the more you can do, the more opportunity you have. How you use your leverage and the amount you need to deposit to be a successful trader are some of the most common questions I'm asked about trading. And it's a very difficult one to really answer. If you want to try trading, put £500 in your account. If you want to experience trading, put £300 into account. If you want to be a trader, put £5,000 into account. To be a successful trader, I would say maybe put £10,000 into an account. It all revolves around how much risk you're willing to take, how much you want to be involved in the markets, and how much pain and not just suffering, it sounds really negative, but the markets are designed to inflict fear and greed and that pain upon other people in the markets. So you need to give yourself a buffer and some protection against that movement. Leverage for me has always been a double-edged sword. It can work in your favour when you're trading well. Likewise, it can work against you when you're trading, badly. The key to successful trading is finding that right balance. There is no right balance that fits everybody across the board. Everybody is unique. Everybody's individual. The amount of trading leverage you might require in your trading strategy can be different than another trader's. And that's the whole point. It's the whole point of my webinars in general. Trying to find out what fits in with you. You're the trader. You understand your margin, your leverage, how much money you have, how much money you're trying to make, what you're willing to lose. That equation is yours and yours alone. I guess traders with less money in deposit are interested in leverage because the less money you have, the more bang for buck you get. So if you're highly leveraged on a £5,000 account, you can trade, anything, 2-to-1 leverage, 100-to-1 to leverage, 500-to-1 leverage. I mean, some brokers offer even more. But at the end of the day, you can't just expect to have a free ride. For every time you get it right, when you're highly leveraged, when you get it wrong, the opposite's going to happen. When you make money, the opposite's going to happen. You're going to lose money. So if you're trading with £1,000 on deposit and you want to trade £100,000 of $1,000 of currency, then you're leveraging at 1 to 100. And this is completely acceptable within the financial industry. Now, why does the financial industry do this? Why do they put money against yours to allow you to trade more? Well, because it's more interesting. If you had to put £100,000 into an account yourself, or $100,000, just to be able to make a few $100s a day, nobody would do it. So the brokers, the people in the finance industry, created leverage, created the ability for people to trade above and beyond what they deposit in order to make more people be involved in the markets, make it more accessible. So it's not necessarily a bad thing, but again, it's not necessarily a good thing for traders. You have to understand where you are on that sliding scale. So how do you understand what leverage is? Well, all you have to do is look at the Intertrader platform. If you're trading something like the DAX, for instance, the German 30, £1 a point requires you to have £200 of money in your account. So that gives you a quick idea of what you can achieve. If you want to trade at the minimum on InterTrader, which is £1 a point, you need £200 for every £1 you want to invest. So if you want to do £5, a point movement, you need £1,000, etc., etc., and it goes up. So that again shows you how quickly you can work out how expensive products are to trade, what it's all about, by looking at the margin requirement, because it tells you. So it's very, very clear. £1 a point in the DAX is quite volatile, might be £200. £1 a point in oil right now might be £300, £400. So the more volatile the product, the higher the spread, the higher the margin requirement. Again, the more risky it is to trade, the more money you then need in your account to take your positions. So again, very simple. So when we're looking at the top of your InterTrader account, you can see your cash balance, your open P&L, your traded resources. So every time you put £1 on, you take £200 away from your cash balance, and that tells you your trading resources. So with this particular account, £3,500 in the account, well, again, you can trade 5, 10, 15, maybe 16, 17 pounds a point before your margin requirements are hit. So that margin in use will tell you. And again, you know that it's £200 per point, and again, that will change, depending on the market conditions. But a basic rule of thumb. So every £5 is 1,000. Times it up by your balance. Again, pretty easy maths. And you can do this with any product. Again, gold rolling daily, £300 a point. DAX 200. S&P 500, Euro dollar 200, and again, it's very, very easy to understand how trading can get out of hand, because you might have £100,000 in your account per se, but then if you're trading 3, 4, 500 lots, very, very quickly you can see that your margin's going to be hit, and your margin requirements. Remember, when you're highly leveraged, things move very, very quickly for and against you, and that's the main problem that people don't factor in, that with leverage comes speed and comes time. So a market moves very, very aggressively, 30, 40, 50 ticks in a 15-minute candle, then that might hit your margin requirement a lot quicker than you were expecting. And that's what's really hurting people in the markets right now, is the volatility, the speed of movement, where the market might have moved, again, in an hour, 20 ticks, 5 years ago. Now it can move 100 ticks. So if you're trading highly leveraged products, with large size, you can fade 20 ticks. You can't fade 100 ticks because it's leveraged, and your losses compound a lot quicker. So leverage, you've been allocated, will be set when you open your account. So you can choose different leverages, depending on what your attitude to risk is. And again, as I say, 100 to 1 is fairly normal, but 2, 3, 4, 500 has been seen by different brokers. So the margin required, depends on each product, and the amount of balance you have is what you are willing to put into the account, and that equation is naturally met. So again, if you've got £3,500 in your account, right now when in trading you can trade £11 worth of gold or £17 worth of DAX. So figure out to you, what's more valuable to you, £11 a point on gold or £17 on DAX. I would say the DAX wins every time, but again, it's down to your preferences. So you have to be aware of the trading resources at all times, because your capital is fixed until you close the position. So you can't just necessarily, add funds, just to kind of get you out of trouble. So if you've got £3,500 of cash balance and trading resources on, then you're all in, very much like poker. You can't get out of that position, until you close it. And you can't just keep adding money into your account necessarily quick enough to cover them positions. So think about that. Your cash balance is what you've got. Your trading resources, how much of that cash balance you're using, and that margin requirement is worked out for you. And if you get to that margin requirement quickly, or unexpectedly, then it's very difficult to add money to your account to kind of get out of that. So that is how people, wipe out their accounts day in, day out very quickly, by not understanding the relationship between trading resources, their margin in use, versus their cash balance. But it's pretty simple. If you ever hit your 50% of cash balance in your trading resources and your margin in use, then really you need to be looking to get out of that position, because if you're thinking about the average trader takes 1% of their account as a stop, if you're hitting 50% of your cash balance in one trade, then the likelihood is you're going to wipe out your entire account. So remember, the cash balance will not reflect the open position. until they are closed. Therefore, if you make money in a trade, it will not show in your cash balance until it's closed and in your account, until it's out of the market. So also the trading resource will not reflect your profit and will not be available until you close your position. So it doesn't matter if you're onside, offside, whatever, until that position is closed, it's not really, it's not counted as real money. And that's another thing that, you have multiple positions in your favour running on your account, but until they're closed, until they're available to be used in your account, then that's when they really mean something. So it's very, very important to know that if you're using all your trading resources, you have to close positions in order to continue. So, take an example. We're long the euro dollar, which, we're buying the dollar, we're shorting the euro. So we're doing 100,000 euros worth. So assume the initial, you initiated the trade above the exchange rate. So €1 equals 1.3600. So 1.36. You're bearish on the European currency and expect it to go down. So you're leveraging. Your leveraging on this trade is just over 27 to 1. So that means 136,000 US dollars trading against US dollars 5,000 equals 27.2 to be exact. So what you're trying to figure out is if you're trading 100,000 euros, that you really, trading at 1.36. So that means you're trading $136,000 versus your 100,000 euros. And understand the pip value. So the pip value is equal to 1/100th of 1%. Or 0.1%. So what you're figuring out is for your £100,000 that you're trading in euros, you're trading £136,000 equivalent in dollars. Yep. So what you're trying to understand is what your relationship, and that's 27.2%. But then you're understanding that every 0.01% of move is equal to $10. So that's what you're essentially doing. You're trading a certain amount at a certain price, but every time that market moves up or down, you're only actually making or losing $10. And that's the real equivalent of understanding margin. That you're talking about hundreds of thousands of euros, which again, it sounds a lot of money, but when you think that, $4 or $5 trillion is traded every day on the FX markets, so really the numbers are tiny. All you're actually doing is each pip is worth, $100, but each movement is actually worth $10. So again, very, very small numbers based upon large numbers that you're investing and trading with. That's margin, in a nutshell. So when you're using leverage, I guess the prospect of generating big profits without putting money down is, it's quite tempting. If you can make lots of money when you're highly leveraged and only put £1,000 into your account, then that's, really again, something that appeals to a lot of people because it seems to be money for nothing. But every time you put £1,000 in your account to double your money, you can lose all your money. And that really is not the point of trading. Trading is about accumulating, and getting, little bits of money and compounding it, not about making them big boomer bust trades. So I think really for me, boom or bust style traders and really encourage themselves to use high amounts of leverage, whereas the more consistent traders lower the leverage and look for the long-term gains, compounding winners, putting money in the account and building up their trading ability in that way. But I guess it comes back to the basic things in trading. If you cap your losses, cap your losses, the winners are going to take care of themselves. There's a reason why these things are said time and time again in trading. So use strategic stops. Strategic stops are quite important. At the end of the day, markets get busy around the cash close, the US Open, so there are times when you're just going to be wrong. So don't get in over your head. It's very easy to kind of get an opinion, get married to a trade, and sometimes the markets just tell you aren't right. If the markets don't go in your favour very quickly and you're highly leveraged, well, then what's to stop the markets hunting out that pain, hunting out that fear, and moving very aggressively against you? You've heard of stop grabbers, pin bars, short squeezes, I'm sure. And that's what the markets use to get people out of positions. And they know that people are leveraged, and their pain threshold, therefore, is less, because the more leveraged you are, the less time you have. So again, use leverage, appropriate to your comfort level. 50 to 1, 5 to 1, 10 to 1, 1 to 1. Again, it all depends how comfortable you are. The more leverage you have, the more risk you take, the less time you have, the more pain you will endure. So work out that balance for you. I mean, again, it's a tool offered by most brokers. I mean, don't again be worried about leverage. Every broker will offer you some sort of leverage because that's how markets work. Even when you're a professional trader, you put money into your account, and the trading companies will offer you leverage. Maybe it's smaller, maybe 2 to 1, 3 to 1, 5 to 1. But again, when you're trading professionally, you trade a much bigger size, per clip, and much bigger amounts. A spread betting company will offer you bigger leverage because they need to make people, feel that their trading dream is achievable on £100 or £1,000. If you're trading professionally, maybe you have to put £100,000 in. So they might give you 5 to 1 leverage. It makes much more sense when you put 100 grand in to trade with £500,000 than put £100 in and get nowhere. So you have to have some leverage when you're trading on a spread betting platform, otherwise people would never deposit any money. So margin requirements, again, are set by the exchanges. That's then passed on to the brokers. So when there's very volatile things, like when the euro and Swiss debacle happened, when there's big change in oil, the brokers will say, right, well, it's not 4 pips per spread anymore, it's 8 pips per spread. The margin requirement has gone up. You need more money to trade that product because it's more risky. So again, very, very black and white. All the volatility will pass down from the professionals to the retail, and everyone will know about it. So you can see the margin requirements. These are things that are sent. Look at the Greek bailout. This is back when, the 12th of July. I mean, it's basically, you think about it, it's a carbon copy of what's happening right now. So when the margin requirements change because of global events, then, that's again, the euro could be affected by a Greek bailout, a Greek exit, a Brexit could affect the pound. When new things happen, the margin requirements go up because any kind of risk has to be taken on by the broker, therefore has to be taken on by the client. And you can see that, leverage, for every product changes. Okay, so 50 to 1 for the currencies. For Netherlands cash, 860. For the Wall Street, 200. All these different products will maintain different amounts of volatility, different amounts of risk, and therefore they will cost you more or less money to trade. So as with most things in life, terminology can be used, can be hard to understand, but it's pretty simple. Essentially your capital allows you margin, the ability to open position. Leverage allows you to capitalize on the margin in a greater way. You're leveraging the amount of money based upon your deposit, based upon what your broker will offer you. Dual-edged sword. The more leverage you select, the more you can win, the more you can lose. But again, trading's all about getting that balanced approach. Alright guys, any thoughts or any questions? I mean, again, that's a bit of a brief introduction to margin and leverage. It's it sounds complicated, but it's not. It's pretty simple. It's all basically maths. It's basically understanding that if you put a certain amount of money into your account, there's only certain things you can do, and you put money into your account, there's only certain things you're going to achieve unless you have leverage. I mean, any kind of thoughts or any questions? And it's not rocket science, these things. We can all work out basic maths. We can all understand what's trying to be, achieved and accomplished in the markets. And if you have very small amounts of money, obviously brokers are going to encourage people to use leverage because then they can then make more. But, unscrupulous brokers that make money, from people trading, will let them have leverage to wipe out their account and put more money in. Again, InterTrader, a market neutral broker, they only make money by you trading. They don't take positions the other side, so they only want you to make money and keep the money in the account. Alright guys, well listen, anything else you want to ask me, get me on my email, sruffley@tradermaker.com, or on Twitter, @SteveRuffley. Ask me any questions there directly. Again, very difficult markets right now. Markets go up, markets go down, but I would definitely look at leverage and how you set it, and speak to InterTrader if you want to. They can definitely amend it for you to get an idea of what you should be using based upon your deposit and what you want to achieve out of trading. No final questions, guys? Nothing you'd like to ask? Well, alright guys, well hope you enjoyed the presentation, and I'll speak to you all very soon. Okay, have a great night. Thank you.